Assalamu alaikum class. This is the third lecture of chapter 9. In the first two lectures, we have discussed the types of imperfect competition, which includes monopoly, oligopoly, and monopolistic competition. In the second lecture, we have discussed the sources of market imperfections, that the factors which create imperfect competition in market. And now this is the last topic of chapter 9. And in this topic, we are going to discuss some commonly used terms in imperfect competition. One of them is natural monopolies and price discrimination, and afterwards, profit maximization condition under imperfect competition. Starting with the natural monopolies. Natural monopolies, that when the economies of scale are so pronounced that competition becomes impractical. Pronounced means obvious, or we can say that when the existing firms has managed to minimize the average cost at so much lower rate that for the other firms it is difficult to compete with them in the same market, we said natural monopolies created. Two examples in context of Pakistan are mentioned. One is the Pakistan Railway and the other is PTCL. Starting with the Pakistan Railway, that it has a natural monopoly in rail business, that other means of transportation are available, but in case of rail services, only there is only one company, or there is only one service available, and that's the Pakistan Railways. No other firm can enter or willing to enter into this business because they knew that they cannot compete with the prices and cost of the Pakistan Railway. In the same manner, PTCL has a natural monopoly in landline services. Over the years in Pakistan, telecom sector has developed, but they're all providing the mobile services or cell phone services. No other company other than PTCL is providing landline service. The reason is that for any newcomer or for any new industry or for any new firm, the initial cost of investment and initial cost of production is so much high that they cannot compete with the rates offered by PTCL. So PTCL has a natural monopoly in landline services in Pakistan. From here, we move to the next topic, price discrimination. It is also one of the very commonly used term in imperfect competition. It means that selling of same product at different prices to different consumers. That when at the same time, for the same product, different prices are charged by the producer. It is price discrimination. That due to difference in consumer, price is differentiated as well. We normally observe this behavior in our daily life as well, that some of the brands which issue the loyalty cards, if a person has that loyalty card, then some percentage of discount is given to that individual, which is not valid for other customers. That is also an example of a price discrimination. In the same manner, WAPDA and PTCL also uses the price discrimination strategy to maximize the profit. For instance, both these two service providers divide their consumers or customers into domestic users and commercial users. So the rate is higher for the commercial users relative to the domestic users. So same services are being provided, but because of difference in the consumer, rates or the prices are different. That is the price discrimination. From here, let's move to the concept of marginal revenue. For that, we will start with the total revenue. Total revenue, it indicates the total sales of a firm, and it is total revenue is equals to price into quantity. Marginal revenue, we have discussed this term in chapter 8 as well, that it is the additional revenue earned or attained by selling an additional unit of the same product, and mathematically change in total revenue due to change in output, that with each additional unit sold, the change occurred in total revenue is considered as marginal revenue. For that, we are using the data Over here, quantity price is given, and from that we are calculating revenue and marginal revenue. Different levels of output, from 0 it goes up to 6. Price gradually reduces to 100, 180, 160, 140, 120, 100, and then 80. And we know that price is also equals to average revenue as well. Now when we multiply price with the quantity, it gives us the revenue, which is increasing with the decrease in price. Initially 180, 320, 420, 480, 500, and then it is 480. To calculate marginal revenue, difference between second and first value of revenue. For the first one, it is 180, then 320 minus 180 is 140, 420 minus 320 is 100, 480 minus 420 is 80, 500 minus 480 is 20, and then 480 minus 500 is minus 20. So what actually we are observing over here, that we said that in case of imperfect competition, the demand curve is downward sloping, which is clear from this data as well, that as the price reduces, quantity is going to be increased. Price reduces from 200 to 180, 160. In the same manner, quantity is gradually increasing, 1, 2, 3, 4, 5, and so on. And we know that with the decrease in price, total revenue of the producer is increased as well. But we cannot assume that there can be unlimited decrease in price. There's a limit to which a firm can decrease the price, and from where the firm is going to identify it by observing the marginal revenue. As long as marginal revenue is positive, the producer is willing to reduce the price of the product to increase its total sales or total revenue. That we observe that at fifth unit, when the price reduces from 120 to 100, marginal revenue is maximum, which is 500, and total revenue is maximum, which is 500, and marginal revenue is 20. A little decrease in price from 100 to 180, even though demand increases by 1 unit, but when we observe the effect on revenue, it reduced from 500 to 480, and marginal revenue becomes negative as well, which is minus 20. So it means that in imperfect competition, firm will reduce the revenue up to the point, reduce the price up to the point where the marginal revenue is positive. The moment it becomes negative, it is not desirable for the firm to further reduce the price of the product. It is mentioned over here as well that as the price reduces, demand increase and revenue increase, and marginal revenue is positive. At fifth unit, decrease in price, marginal revenue is negative, which means that firm had decreased price so much that total revenue declines as well. So that's the relation which we have observed, that marginal revenue is required by the firm to know that to what extent it can reduce the price so that sales or revenue can be at its maximum level. All right, so the next topic from here is the differences between perfect and imperfect competition. Up till now, we are keep on discussing the differences, and now I have mentioned it, so you can easily compare it. In perfect competition, large number of sellers. However, in perfect competition, few sellers or could be single seller as well. Perfect competition, producer is a price taker, cannot determine the price. But in imperfect competition, producer is a price maker or can influence the price to some extent. Identical products in perfect competition, however, product differentiation occurs in imperfect competition. In perfect competition, there is a perfect knowledge in market, no uncertainty. But in imperfect competition, uncertainty exists in the markets. Firms do not have perfect knowledge. Perfect competition, free entry or exit of the firms, but in imperfect competition, there are barriers to entry. It could be the legal barriers, it could be the high cost of entry, it could be the advertising and product differentiation, which limits the firms to enter into an industry. Then demand curve are different as well. In perfect competition, it is a horizontal straight line. Imperfect competition, downward sloping demand curve. So these are the different differences which we keep on discussing between these two market structures. But along with all these differences, there is one point common between perfect and imperfect competition, and that's the profit maximization condition. That profit maximization condition is same, either it is a case of perfect competition or it is imperfect competition. There are two conditions for profit maximization. First one is that maximum gap between profit and total cost, or in other words, profit is maximum. And second is that marginal revenue is equals to marginal cost. To show these two conditions, we are considering a data over here. Output is given, or the quantity is given, price and total cost is given as well. From price and quantity, we can determine the total revenue, which shows that when we multiply price with the quantity, output is 0, total revenue is 0. For the first one, 1 into 180 is going to be 180, 2 into 160 is 320, 3 into 140 is 420, 4 into 120 is 480, 5 into 100 is 500, 6 into 80 is 480. However, total cost is given even when the output is 0, which is 145, and then it gradually increases 175, 200, 220. Then it is 250, 300 and 370. Now when the output is 0 and total cost is given, it indicates the fixed cost of production. We have discussed it in chapter 7 as well. I'm just giving a review over here that if output is 0 and total cost is given, it indicates the fixed cost. Now from this given information, we are going to calculate the two conditions. First one is that maximum gap between revenue and cost, which means profit. So the next column is for the profit. We subtract revenue from the cost. Initially it is going to be minus 145, 180 minus 175 is 5, 320 minus 200 is 120, 420 minus 220 is 200, 480 minus 250 is 230, 500 minus 300 is 200, and 480 minus 370 is 110. It shows that when the output is 4, profit is maximum, which is 230. But we have to observe the second condition as well, that when the marginal revenue is equals to marginal cost. Over here, this first condition is satisfied, maximum gap between profit and cost. Sorry, it's between revenue and cost, and second is the marginal revenue is equals to marginal cost. So for that, marginal revenue, difference between second and first value of total cost, and marginal cost we calculate from total cost. For the marginal revenue, 180 minus 0, over here we are calculating marginal revenue, then 320 minus 180 is 140, 420 minus 320 is 100, 480 minus 420 is 60, 500 minus 480 is 20, and then it is 480 minus 500 is minus 20. To calculate the marginal cost, difference between second and first value of total cost. Output is 0, marginal cost cannot be measured. 175 minus 145 is 30. We are calculating it from total cost, right? 200 minus 175, 25, 220 minus 200 is 20, 250 minus 220 is 30, 300 minus 250 is 50, and 370 minus 300 is 70. It shows that now when we compare that marginal revenue and marginal cost, there isn't any point where marginal revenue is equals to marginal cost apparently. Then we have to read the table and identify the that where the profit could be maximized or where both can be equal. So initially, as long as marginal revenue is greater than marginal cost, the producer is willing to increase the output. 180 is the marginal revenue, marginal cost is 30. So producer sells the second unit, 140 is the marginal revenue, 25 is the marginal cost. Again, it is willing to sell the next unit, 100 is the marginal revenue, 20 is the marginal cost. And at fourth, it is the same thing, that 60 is the marginal revenue and 30 is marginal cost. It means that the cost of producing an additional unit is less than the additional revenue attained by selling an extra unit. Or in other words, let me explain it again, that as long as the additional revenue, which is marginal revenue, is greater than the marginal cost, the producer is willing to sell that unit, and it continues till fourth level of output. When it comes to the fifth level, now the marginal revenue is 20 and marginal cost is 50. It means that additional cost of producing this unit is greater compared to the additional revenue attained by selling this unit. So it is not desirable for the producer to sell fifth unit. Secondly, when we observe the profit is also maximum at fourth level of output, and over here marginal revenue is also greater than marginal cost. So we said that fourth level of output is the profit maximization point for the producer. If marginal revenue is not equals to marginal cost, then we are going to look for the condition where the marginal revenue is greater than marginal cost. And we observe that over here, profit is maximum as well. So fourth is the profit maximization point for the producer. So it is mentioned over here as well that as long as marginal revenue is greater than marginal cost, firm is willing to sell an additional unit as the profit margin is increasing. But if marginal revenue is less than marginal cost, it is an indication of loss for the firm. So we are going to conclude this topic over here by saying that a producer is going to maximize the profit, either it is in perfect competition or imperfect competition, where marginal revenue is equals to marginal cost and profit is maximum as well. So over here, chapter 9 is completed. If there are any queries, we will discuss it in the live session. Thank you and Allah Hafiz.